Now going to navigate over to the Power Options suite of tools, and I of course will use that to help us illustrate the concepts and the answers to the questions that do come in. Let me just change the screen here. And we are all set. Got a couple of questions that have come in. Excuse me, but before that, I just want to mention to everyone, if you just started using Power Options, if you're just starting on your trial, I encourage you to take advantage of the 4 steps that are listed here. The free quick start guide, of course, free flash tutorials to help walk through of the different tools to help you get more familiar. We have a variety of free webinars during the week, and of course also archived. Best place to access the archive is right up here underneath the My Home tab. 4 categories there: Power Options tools, options strategies, options concepts, and requested topics. And any trial member or subscriber can schedule a free coaching session at any time. Actually, if you're on your trial or a subscriber, there's no limit to how many you can have. It's not just one free coaching. You can have as many sessions as you want as a trialer or as a subscriber. This is essentially a 35, 45-minute conversation with Ernie or myself. We will walk you through the tools on the site and answer any questions that you have. All right, so let's start off with Chuck. Chuck and I have been talking via email. Chuck has been talking to us via during these webinars as well. It's good morning for Chuck. He's from down under there, down in Australia, New Zealand area. But Chuck's question is, can you confirm my point about credit spreads versus debit spreads? If I increase my bid on a credit spread, I just make less money. If I increase my bid on a debit spread, I can completely give up my expected return. Is that correct? Well, I'm not really sure. I don't know if we have the right terms there. So looking at a credit spread versus a debit, if you increase your bid on a credit spread, you make less money. Well, if you increase the bid, the order, Chuck, on a credit spread and you get filled, that would increase your return. Okay? Let's take a look at bull put credit spread. So credit spread, of course, is a combination of selling one option and buying one option where we'd receive a credit. A bull put credit, if we have a stock trading, let's say at 50, I might sell a 47 put and buy a 45. Now, both puts are out of the money, but in this case, I'll get more for the 47, so we'll receive a credit on the position, maybe 20 cents or so, with a risk of about $1.80. A true risk. Yes, it's a 2-point risk, but we keep the 20 cents regardless. That's a bull put credit spread. Now, I could do the same structure with calls, but it would end up being a debit spread. They're parity trades of one another. If I sold a slightly in the money 47 call and bought a slightly deeper in the money 45, I might be paying a debit of around 180 or 190 in that case. However, in both situations, credit or debit, in this case, if the stock stays above 47, well, both puts would expire worthless and would keep the 20-cent net credit. On the debit spread, if it stayed above 47, we'd essentially buy shares of stock at 45, the bought call, and sell them at 47, get $2 back, and we'd have our profit of 20 cents over a debit of 180 or so. That's why they're parity trades of one another. So if you increase the bid, if this was originally a 20-cent net credit, at the natural bid of our 47 put, bull put credit spread, and a natural ask on the 45, the option that we're buying, if that was 20 cents, but I went midpoint and increased the bid, then I might get 24 or 25 cents. So this might be a higher net credit. It doesn't change the probability in this case. And maybe that's where the mistake is. I'm looking at your question, Chuck, as if you increase the bid of what you saw as a natural price, if you increase it to get closer to midpoint, will you make less money? No, that's not the case. Now, if you try to look for credits that are higher, which means you're less out of the money, that does mean you'd have a lower probability of getting assigned. Okay, so if I went with a stock at 50, if I went to a 49.47, I'll get a higher net credit. Now I have a lower probability of the stock staying above that strike and expiring worthless. And if I go with the out of the money, which I would only do with a debit spread, and we'll talk about that in a moment, then in that case, I would have a lower ones as well. And it says, in your terminology, I mean reduce the bid. Yes, but it doesn't mean it's nothing, okay? So let's go back one step. I'm going to enter, let's say the market's open. I'm going to enter a bull put credit spread. Excuse me, I'm going to go to Power Options. We're going to go to the search. And these are the weekly bull puts going 14 days out in time. And so I see the breakdown here. And that first position on team, on Altesian, well, I've got a bid of 95 on the short option. I'd be selling, excuse me, let's start from the beginning. Stock's at 145.70. I could sell the February 7th 135 put, bid of 95, ask of 115. And I'd buy a February 133, 2-point spread, similar to the example we just saw. Bid of 65 and ask of 85. So if I did the natural, that means I'd be selling at 95 and buying at 85, which would only give me a 10-cent net credit on the position. However, I'm definitely going to try to go to midpoint. I would enter this order at the midpoint net credit of 30 cents. 105 to sell to open the February 135, and 75 to buy to open the 133. That's how I would place my order. Now, what Chuck is saying is I went into my broker right now and I placed this order using the midpoint. Let's go to the profit and loss chart. Let's clear up my little sketches there. Okay, and this does have a high probability of expiring worthless. It was about 86, 87%. Okay? So if I get the midpoint, I'm looking at a 17.6% return on the position. Now, what Chuck's saying is that if I entered this spread with my broker at 30 cents at midpoint, and it's not going to fill, it's not triggering. For some reason, the market maker is being a little bit difficult. Well, then what I likely may consider is moving the request, the limit order, down. It's not getting filled at 30 cents at midpoint, so then I'll go ahead and try 25 cents. Now the question is this still a viable spread? Am I likely not to get as decent a return on the position if I do this? Well, not really, because if we think about it this way, yes, we're lowering the net credit. Now it becomes a 25-cent net credit divided by a risk of 175. That's still a 14.3% potential return. All right, I'm giving the market maker some leeway to get filled at this position, 14.3% return. I'm still happy with that, and it's still meeting my goals of a minimum credit spread return. And it'll probably get filled. If they weren't filling it at 30, it'll probably go at 25 cents. I really haven't had much problem with the 2-week out spreads that I use right from that list typically getting filled at the midpoint with these positions. Now, if I lowered it further down to 20 cents, divided by the new risk, which would be 180, 2 points divided 180, that's going to be an 11% return. That's still probably pretty decent as long as on average I'm keeping my returns to my target goals. This is still acceptable. Again, depending on what your goals are, Chuck, and what your analysis. So I could even go down to 20 cents, which would probably trigger right away. I'd rather get 25 cents and keep a 14.3% return in this scenario. That's what I'd like to look for. So one of the issues that we come across with these is we looked at the bid-ask spread of these two options, and we looked at the midpoint. So we were looking at a 95 to 105, right? It was about essentially, 95 to 115, right? Is that what it was? Let's take a look here. Yeah, 95 to 115. That's a 20-cent bid-ask spread on the short and the long in this case. For a 2-week out trade, that might be a little bit high, but as I mentioned before, I've seen 30-cent net credits or 30-cent bids and ask differences and gotten filled at the 15-cent midpoint between the two, usually without any issues. So this isn't too bad. Usually I'd like to see it around 10 or 15 cents. That'll usually help me get the midpoint. And of course, on power options, when you're searching for credit or debit spreads, you can filter directly for, there it is, I'm sorry folks, you can filter directly for monetary short bid-ask spread. You could limit that to less than 10 cents, 20 cents, or 30 cents, or percentage bid-ask spread as well, so you're not seeing anything that's too far out of bounds. And you can limit that out right away. A parity trade, as we just mentioned, and this is where things get a little bit tricky. Chuck's other email that we had discussed that he had sent 10 days ago was in relation to the fact that he hasn't been able to get filled successfully a lot of the time with the debit spreads. This position here we discussed has a high probability as a bull put credit spread. What does that mean? It means a probability of staying above our short put strike price at 135, where both puts would expire worthless when you keep the net credit. Now, I could do an in-the-money debit spread with the same strikes and have roughly the same return, in theory, except I'm going to sell the in-the-money 135 call and buy a deeper in-the-money 133 put for a debit. It'll have almost the same risk-reward profile, the same probability. But let's take a look at what happens there. This was for February 7th, okay? So let's look at the call side on February 7th. Our in-the-money 135 is 1250 by 1340. 1250 bid, 1340 ask. 133 is 1360 by 1510. Okay, so here's where things get a little bit tricky. As you go deeper in the money, looking for a high probability debit spread, the bid-ask differences are higher. I mean, we're looking at $1.50 here on the 133 and 90 cents on the 135. There's less of a likelihood I'm going to be able to get the midpoint prices on these positions, and this is almost double at midpoint. But this is what Chuck came across, is that going into these positions of this nature where the bid-ask spread is wider, you're likely getting closer to maybe $12.70 here for the bid, 20 cents above this, and you're probably more likely to paying closer to $14.70 on this side or $14.50 on this end, closer to the debit, or closer to the natural ask, excuse me, I said that wrong. So in which case now, our debit's back that 25 cents. So in this case, it's harder to get filled within the money debit spreads than it is to get filled with out-of-the-money credit spreads, because the bid-ask spreads are tighter on the out-of-the-money options, and getting the midpoint for the good return, I've always experienced, is easier to get within the money credit spreads. Out-of-the-money credit spreads where the bid-ask is lower, as opposed to the parity trade, which would be an in-the-money debit spread where the bid-ask spread difference is wider. As I mentioned, though, if I'm searching for debit spreads, I can control that on the power option search, credit spreads or debit spreads, to narrow down the bid-ask spread monetarily or percentage-wise. Now, one thing that I can do with a debit spread that I would never do with a bull put credit spread, or I would ever do with a credit spread, we could talk about the bear puts as well. One thing I can do with a debit spread is to get a better risk-reward ratio if I'm neutral to bullish on the stock, as I might sell a 147 and buy a 145. Again, we're at a 2-point spread, but the midpoint is a little bit tighter. It's only about 20 or 30 cents again at the money. Here we're at 40 cents, excuse me, and here we're about 40 cents. So I think a 450, 550 is a little bit more logical. It's a little bit more believable to get the midpoint than that $1.50 we saw for the in-the-money call and the 50 cents or so we saw on the other one. 90 cents, excuse me. Now, this is an interesting way to approach it. You know, stock's almost right there. What have we got? Well, if we're bullish on the stock, rather than taking a high probability trade on a credit spread that's out of the money, and as we saw, looking to make maybe 25, 30 cents on a $1.75, $1.70 risk, roughly about a 6 to 1, 5.5 to 1 risk-reward ratio, an out-of-the-money debit spread. In this case, we only have a debit of $1 to potentially make $2 back, right? Because if the stock here on the debit spread, if it moves above 147, what happens? I essentially buy shares of stock at 145 with my long call and use that to deliver my obligation of the sold call at 147. I get $2 back. So it's a 1-to-1 risk-reward ratio. Now, why wouldn't I do this with a bull put credit spread? because in that case, my 145 put is still out of the money. It's reversed. These aren't in the money now. It's out of the money, but the option that I sold is in the money. And that means I could be assigned at any time on the 147 put with an out-of-the-money bull put credit spread. And I can't use this to hedge it unless the stock's trading below 145. I'm trading a credit spread because I don't want to own the stock. Okay? So in that scenario, that's why you never do an out-of-the-money, that's why you never do an in-the-money bull put credit spread or bear call credit spread, because this short obligation, being in a spread, doesn't change the obligation of selling the put or selling the call. You still may be obligated to buy shares of stock at this price or be short shares of stock on the short call. But in a debit spread, bull call debit spread, the reverse, this is an out-of-the-money call. I don't have any obligation until the stock moves here, and I'm holding that deeper in the money call that completely covers that, and I had a 1-to-1 risk-reward ratio. This is how many investors I talk to use the debit spreads. Instead of going deeper in the money for a higher probability, they look for closer to a 2-to-1 or 1-to-1 risk-reward ratio, accepting that it's only a 40, 45, 50% probability that they'll make the maximum return on the position. It's more of a speculative bullish play as opposed to that. But the key is, in relation to Chuck's question, looking back at that bull put credit spread example on Altesian or others, is that if you feel that you are not getting filled at the midpoint that you entered, going in at midpoint, so you changed already from the last update of the day, it's at 25 cents now, but that's still 14.3% to me. That's still pretty good. I still like that. Okay? That's still a good return to me. I'd like 17.6%. But what I want to make sure is that if I have to lower it again down to 20, am I still comfortable with a new return of 11%, or should I just move on to a new position? Or should I adjust my criteria in my power options search to limit the bid-ask spread more to hopefully get filled at better prices with the return I want and the probability I want as well? Okay, so I guess that's kind of how I want to answer that question there for you, Chuck. Related to that, the problem is with the debit spreads, and we just showed why. And in that case, the problem with the debit spreads is because when you go in the money looking for a higher probability on the debit spread, you have a wider bid-ask spread, and you may not get filled as easily as possible. You might not get filled as well, and that's kind of the issue there between the two.